Well, hello there, welcome to this video tutorial. This is sort of a sequence of videos where we're going to analyze how fast margins can change using a portfolio margin account. We're focusing on the TIMS model, but again, beware that as you go broker to broker that they could have different risk models and calculations. So you have to contact your broker and see exactly how they calculate their margins. The one we're looking at is the TIMS model. And let me just explain how that works real fast in case you're not familiar with it. So the TIMS model will create an array of 10% down and 10% up, and there's slight variations. Again, you have to check with your broker. You cannot draw on that. That's off the screen, sorry. So plus 10% and down 10%. Okay, so this is called TIMS. You can read more about it on the Options Clearing Corporation website. They have a documentation on this. And there's a couple different models, but the common one is sticky strike. So anyway, I'm not going to spell that out. It's called sticky strike. And what the sticky strike is, it's a risk modeling method that assumes the volatility will remain constant on every option contract. Okay, as the market moves around, the vols are assumed to not change on each option. Okay, then within the risk array, they'll create different slices. Say you have the 10% and then so on, you're at the money somewhere in the middle, and then it'll go this direction. And then the model will locate the greatest risk within this 10% array. So like if you're doing a bull put spread, for example, and your risk profile looks kind of like this, or your day step line, then it'll locate 10% down, and this would be the greatest risk within that risk array, so this would be the margin. They also add in like $37.50 per contract on top of that. And that's supposed to cover slippage if the broker has to liquidate your account. So again, every broker has slight variations. You'll have to contact them. So this is essentially how it works. Let's say you had like a condor trade again, and then your day step line looks kind of like that. It'll measure 10% up, 10% down, and then it might locate this point is the lowest or the greatest risk, and then that'll be your margin. A strangle type of trade, could essentially look kind of like this. And then again, same type of thing. Oftentimes it'll measure depending on how you have the delta set up, but if you're kind of flat on your delta, oftentimes the risk will be over here, and that'll be your margin plus $37.50 per contract. Okay. If you do kind of what we'll look at today is a different one that looks a little more like this. We're going to look at the put front ratio for a credit, and again, you'll have your day step line, and the margin will be somewhere over here. Okay, so the other thing we want to understand is as the market moves, your margin changes with that 10% mark. So if your 10 starts here and then the market moves down, now your new 10 is over here. And so if your day step line moves down like this, then your margin is going to increase because the risk increases within the 10% array. So what I want to look at right now in this video lesson is how those margins will change on the put ratio. And then we'll look at some other strategies in other videos. So we looked at the strangle, and if you haven't seen that video, watch that one. You'll see that the margins triple in one single day. And when the margins dynamically change that fast, then you don't have time to adjust. And you can't size down in time, and then you're forced into liquidation. You lose a lot of money. So today we're going to talk about this put front ratio as a credit. So we're selling close to the money here, and then we're buying here and selling 2 over here. So it's actually a 2-by-1. I'm selling 2 here, and then buying 1 over here closer to the money, and this is a put front ratio. Put some software will label this as a back ratio, but the software is actually wrong. Okay, you have different types of ratios. You have back ratios and front ratios. This is the front. Not sure where the name came from. It could be because it looks like belly up, and the other one goes down and looks like belly, or whatever, the back. So this one's a put front ratio. You have a front ratio when you're selling more than you're buying, and it's a ratio, meaning they're not even like a 2-by-2 a vertical. It's not a vertical, it's a ratio. All right, I'm back. Sorry about that. There was a phone call. So hopefully the video is still coherent. And where was I? So we were looking at this trade, and this is actually a put front ratio. So we're selling more contracts than we're buying. There's all kinds of configurations you can do with this type of trade. But in this one, we're buying close to the money, and then we're selling a little bit farther out, somewhere between the 25-30 delta, trying to get a credit on the trade, and then it's creating a little bit of positive delta. The trade will have negative vega and negative gamma. But I'm not going to get into all the Greeks and the risk and things on this one. We just, again, as part of the series, we want to see how much the margins are changing. Okay, sorry, I got disconnected. Okay, so again, this one, we're not going to talk too much about the Greeks and things like that. We just want to look at the margins and kind of focus on that. So if you go down 10%, you'll see that the trade starts with a margin about 34,000, which you can see up here. I moved down 10%, and then the day step line's at $34,000 loss. So the margin there again is 34,000, and then we'll advance 1 day, and then it's a really big day down, and the SPX dropped over 8%, and then you go down 10 more percent, and now you can see the margin is 92,000. So the margin basically tripled overnight. So again, you have to be aware that this could happen, because it's crucial that you understand the margin risk when you're trading portfolio margin account. So if we break it down a little, so market dropped 100 points, or SPX dropped 100 points, went down over 8%. Then we measure down another 10% to get the new margin. So the new margin is 92,000, and it started at 34,000. So it basically tripled. So, and then there's also a drawdown on the trade, which we'll look at in a second. But let's say you started with 100,000. Let's say that that's your net liquidation value of the account, and then you were using, so we'll just say, we'll call it the NAV, and then we'll say that your margin, we started with 34, something like that, 34,000. So we began the trade using about a third of your buying power. 1 day margin goes up to 92,000, which is almost triple. But what's your net liquid value at that point? So I kind of have to delete those drawings to see. But we can see up here that the trade's down 30,000. So I have to draw that over, but basically we started with 100, so now we have 70,000 left. So the value of your account is now 70,000, but the new margin was 92, I think. So you have a margin call in 1 day of 22,000. Okay. And this was using only a third of your buying power. So you're only using about 30% of that account, and you still had a margin call of 22,000. So this is the type of testing that you want to do so you can avoid these margin calls and account liquidations. It's really important. So you probably might have to be under using 20% or less of your capital to avoid that. So those are things that you can work out on your own time. I was going to do more, but anyway, had a phone call and now I guess I'm too exhausted. But that was one study, and then you can, as homework, I would suggest going back to the price charts and then taking if you're using the put front ratio, which I would discourage you from doing anyway. I wouldn't recommend using that particular trading strategy. But anyway, so if you insist on using it, then go through your price charts of whatever product you're trading and check the large moves. Since it's a put front ratio, you'll want to check the moves where it's going down, because that's when your margin's really going to increase. And then check the 1 day moves, check the 1 week moves, whatever you really want to do, but make sure you spend time doing it. But I can quickly see you probably don't want to go over 20% of your capital, or you might get serious margin call. So I hope you found that video helpful, and we'll see you in the next tutorial.